Hello, friends, and welcome to a tradition unlike any other. No, you're not in Augusta, Georgia. You're on Fast Market on the TDA Ameritrade Network. Welcome to Friday, April, what is this? April 12th.
Already.
Thank you. You know, this has been a busy morning. So let's welcome in Larry Shover, CIO at Efficient Advisors, and Alex Coffey, Senior Specialist here at TD Ameritrade Network. So, guys, we had a lot to talk about today. We have a lot of things going on, a lot of trades that we put on that are in some interesting situations. Yeah. But first and foremost, we got a market that's running.
Yes.
Opened up strong. What do you think? Let's talk about, first and foremost, the week in interest rates, right? Because we had a lot of, I would call inflationary data come out this week.
Yep.
Some of it a little hot in the headline numbers, but ex-food and energy, pretty tame.
Yeah.
That being said, 255 now on the 10-year, Larry.
Yeah.
Larry Shover, go ahead.
Yeah, and that, obviously today is a big move in the 10-year. We see like a volume bulge right there at 255. That said, the core numbers, the inflationary core numbers have not been very impressive. Right. We still see compression and a big grab for duration given the compression in, you have qualitative easing in UK, Eurozone, Japan. So, I think you're going to see people buying the dips, meaning you'll see a lot of people buying the duration right here with, rates a little bit higher.
Is the fact that these were a lot of the hot numbers, or warm numbers, we'll call them, in PPI and CPI, is the fact that those were warm based on energy, right, and rise in energy prices that accounted for a lot of the heat in some of these numbers, Alex? Is that discounted from these numbers? Not today, but remember, bonds didn't do anything all week.
See, I think it's what the market wanted. It's continuing to kind of thread that needle between not too hot, not too cold, kind of that Goldilocks data point that we've continued to see, data point after data point. But I think the big story today, obviously, it's the financials coming out, JP Morgan and Wells Fargo, but it's really, we talked all week about how the market's been waiting for the earnings season to kick off, and it's been slow all week. You're seeing already this morning.
Right.
We're back. We're moving. We got 630,000 S&P futures already traded today. We only were averaging barely 1 million the rest of the week. So it shows that the market really was waiting for these numbers and seeing what these banks had to say.
Larry Shover, it's the first week in April.
Yes.
Right? You've got an up market on a Friday in mid-April. What is that going to do to VIX? Because what you're seeing here, you've got a 12 handle in VIX, and it's really 12.5 handle. I mean, it's down significantly, and Friday, I don't see it going up anytime today.
No, it could definitely stabilize.
Right.
VIX has been a crowded, the short VIX trade has been a very crowded trade, along with rate volatility. The central banks have come out and said we're not going to raise rates. The balance sheet, all the news is out, so vol is coming in. It's become a very crowded trade. It worries me a little bit.
Larry, do you adjust your expectations on VIX based on the calendar? Because I do.
Oh, yeah.
Right.
Yeah.
I mean, this time of year, you have to be careful with too much volatility at too high of a price, correct?
Yes, and we saw it 3 times last year where the VIX gets down to this level. There's some kind of cross-asset contagion, and this crowded trade, everybody's heading for the exits at the same time. And
it will grind lower. Alex, we have a lot to talk about today, but let's first get to the trade that we did yesterday on this show, and let's go through JP Morgan. Now, JP Morgan, we went through extensively on yesterday's show, and we decided, based on what it was, everything we saw, Larry Shover, that the expected move on JP Morgan, which was right around $2 only, that it was way too small. So we do something we don't normally do as a retail trader, and we don't normally do on this show. We bought the straddle in JP Morgan.
What did you pay for it?
Here's what I'll show you exactly what we did here in JP Morgan. We bought the straddle 1 week out. We gave ourselves a little more time, and we bought the straddle. I think it was 294, 293 range, right there. And as you can see, we've got a nice winner when the actual move turns out to be double the expected move, and we've got some time left on that straddle because it's what, 6.5 more days to go. Or actually, it's only 6 days because these expire next Thursday.
That's right.
Not next Friday because of the holiday. So if you're looking on your screen, everyone, and you see expiration only 6 days away, that's because markets are closed next Friday. So that's a key point for everyone to look at. Now, but that being said, we've got a nice little day here in JP Morgan.
Absolutely, and we talked quite a bit about this off air actually yesterday too, because I was kind of, being younger, I don't typically ever look to the straddle. And
this is not your
I wanted to pick your brain on, how you guys came to this conclusion a little bit. And, it was only about 290, and if you and you went out the extra week because it really was only like another 70 cents to hit that extra week.
It was 220 for the 1 week, Larry, and only 290 for a week out.
And so looking at like a JP Morgan Chase, this is a stock that we talked about, it's probably going to move on these other bank earnings next week. So even if you didn't get the move today, which you end up actually getting, you may get it even next week when a Goldman reports, or a Citigroup was kind of the logic you were using. But also you didn't really have a directional feel with the banks. You kind of felt like where earnings were, what's going on with the interest rates across the world. It could go either way.
Yeah.
And so you elected to kind of take a neutral directional stance, but really were just betting that that move was going to be outsized, which ended up actually
Now we've got about $530 in P&L on this name, but here's the thing. Monday, you've got Goldman Sachs and Citigroup. Tuesday, I think you have Bank of America.
Yep.
Wednesday, Morgan Stanley. So you're not done in this financial space, but Larry, you're getting a move in a bunch of those already. The whole sector's up today.
Yes. And my question to you is going to be like, well, what are you going to do with this winner?
Yeah.
I mean, one of the hardest things in trading, as we all know, is like, holding on to your winners, like leveraging your winners. Are you just going to get out of this, sell it, or?
I believe they wrote a song about that. It's know when to hold them and know when to fold them,
Right.
I believe. But yeah, you're exactly right. Is this enough? Because if you look at the whole sector, they're all up. And if one misses, they'll all soften again as well. So even though earnings is such an individual game because each company's different, you can see that the whole sector goes up on JP Morgan's good earnings.
They did, and so when I look at something like this, you essentially doubled your investment in just 1 day, and you basically have it all in the call side. So if I was going to take action, I probably wouldn't take the whole straddle off. I would just take that call side off. It looks like you only have about 9 cents left in the puts, in case maybe you had something happen next week with Goldman, Citigroup, or Bank of America that maybe turns the whole sector around. You may be able to kind of get both sides.
Yeah, because it is $4 out of the money though, and if you're looking at this as one trade, I personally am inclined to I don't like to sell really cheap things that have a chance to go back up. Alex has got a great point there. So I understand that. Now the question is, I like to play the ebb and flow in the market. I mean, it's already down $20 or $30 since we came on the air here, and it was a little higher earlier this morning. So my thought is, do we put in something where we create a closing order? Now that's not a closing order. Hold on one second. Sorry about that. We create a closing order. There's our calls trading about $4.50. Remember, we traded $2.90 for the entire thing.
Well, I think it's important to look at this also too. You have a whole week to go, and you're about $4.50 in the money from where we're trading. This is essentially trading almost like stock at this point. There is not that much, if any, real theta burn or anything working against us, but it really is going to come down to, do you think JP Morgan's going to continue to kind of grind upwards, or are you just comfortable, hey, we bought this for about $2.90, we can take it off for $4.55 around in 1 day. And I think that 1 day is the key point there, because how quickly you were able to turn around that percentage return on capital.
Yeah, and even if the stock retraces a tiny bit, that call is going to go away quickly. So my vote would be to sell that call and leave your put hanging out there, because 1 in 100 times that put's going to work out for you.
Here's what we did. We just put in an offer about a nickel above the market. We put in a $4.60 offer. See if some ebb and flow during the show takes it out. I hate to just bang things out, especially when there's a little ebb and flow going on in this name. So it's already up a little higher. If it gets to $4.60, we'll blast it out and say goodbye. Keep this account moving.
There it goes.
And a fill as we speak.
Great.
For about a nickel higher. So okay, there's our first one. Now let's get to someone that another trade that we're having a little fun with. If you look on the trade here, if you click on something, you can see what date we traded it. The 10th. That was Wednesday, right? So as you can see, what we did, if you were watching the show on Wednesday, we had a discussion and we decided on a long Disney, short Netflix pairs trade. And we did it, if you notice, we did it about 150 deltas by 50 deltas.
Okay.
Okay? And as you can see, not a very big position, but in terms of that, about just under a $1,300 winner. Based on everything. Remember, you've got not only Disney up substantially, but you've got Netflix down substantially. So, guys, this is another one of those. Now, we are risk defined on both these trades. Now, actually, our biggest problem in Disney is we have a diagonal on. And the underlying went through our strike. If you see this on the Analyze tab, if we put up Netflix, you'll see what our really only problem in this trade is it blew by everything quickly.
Oh, yes.
Did I put
Disney?
Netflix? I'm sorry, Disney. Sorry. Disney, as you can see, we went to here instead of, we were short the 120, so we're $8 in the money. So we actually have a short delta right now in Disney because the front month that we had on today is 100 deltas now.
Sure.
Right? So you're actually short. Now, there's no added risk. There's no risk to this. The main risk is some of your profitability could go away. But make no mistake, you know, it's a little odd to look at something that you were bullish on and see a short delta, Larry.
Yes, exactly. And that's the nature of the beast when you're trading convexity, when you're trading options. And when a position ever gets to a point where you don't understand it, or maybe you can't believe it. Now, I know you understand it and believe it, but in case somebody doesn't understand and believe it.
Not always. No, but you're right.
It's best just to get out of it and reset. Because I'm wondering, is your conviction still, are you still bearish on Netflix and bullish on Disney?
We played this move. This is what we were looking for, right?
Well,
Disney's Investor Day coming out with their streaming services. We didn't know that they would go so substantially lower than Netflix in their pricing. When I saw that break yesterday on my phone, I'm like, oh, I knew what was going to happen to both Disney and Netflix.
Well, if I remember, too, I think initially Disney was actually somewhat down on this news, too, so it takes a second for the market to process and kind of figure it out. But when you look at something like this, and when you I wasn't on the show when you guys actually took this idea and put it into action, but this was beyond what you could have even hoped for.
Right.
This was the perfect move, even too perfect to some extent.
When you play divergence, you want that relationship to improve. Right, you're long one, short the other, and you want that divergent relationship to improve. Very rarely do you get one going up a lot and one going down a lot.
Right.
It doesn't always. I've said this a couple times on this show, but it doesn't always go that way, right? It doesn't. It's not this easy.
Yeah, I mean, this is like a grand slam, and with that, what more is there to leverage? I mean, unless
I agree completely.
Okay.
This is one where you just take it off. I mean, at this point, it's a massive winner in terms of the amount that you outlaid and the size of this trade. That to me, this is a no-brainer.
And to be thankful and move on.
Create a closing order. We'll buy the. We'll sell out the. Oh wait, hold on.
Because Alex, I don't know if you agree with this, but I feel like the news is out. And so, how much more is there? I mean, are you still bearish on Netflix, bullish on Disney?
Well, and you have to look at too. I mean, you do have capital invested into these trades. That if you're not going to get a whole lot to come, that you're basically at the move. You can take it off and redeploy that capital elsewhere. If you find something else, then you find opportunity in it.
Yeah. So I think Kevin's doing the right thing.
Now we will close the Netflix trade. Just buy that vertical for 76 cents.
Yeah.
And now both those are locked in profits. And as you can see, our profit, total profit on this was around $1,200.
And looking at this as well, it doesn't look like have we sold the call, or is this a different trade?
No, that was that. Did I do the wrong one? Hold on. Maybe we didn't fill. Diagonal. No.
Or did we do it twice?
We'll figure it out. Anyway, that is that trade we are closing out here. I wonder if it just didn't go. Go ahead.
One last question I have for you too here. It looks like you have a short put spread. It looks like this is expiring today. Basically, trading at this point, you just let it go, right?
Yeah, exactly. Short. We are short the 112 puts in Disney
with 0 days to go. If this was maybe 2 weeks to go, you may be thinking about taking it off.
That might be what I closed accidentally instead of the other one. I don't know. But we'll figure that out during the break. But before we get to the break, I want to get into our trade for today based on Monday's earnings, which is Goldman Sachs.
Yeah.
You're right. The financials, they've started to come out, but We're just at the beginning of earnings season, as you know. So Goldman Sachs is the next trade we want to do. And Goldman Sachs, here's one of our problems. It's a good problem to have that we're having such a good day today, but here's the problem. Goldman is up $5, up 470 here on the day, and it's making a move when, remember, if you open up next week's numbers, you're going to see, this is the way you got to create what the expected move is, because you won't get that expected move until the front expiration goes off the board.
That's correct.
So what we can do is look at the 207.5 straddle. Looks like about, let's see, if we wanted to buy this, it looks probably in around $9 range, which is a pretty big move.
And what's the expected move?
Well, we don't know yet because it's not till Monday, but the expected move for the week in Goldman is right around $9.
Okay.
So I imagine that this one-day move is going to be
$7.50 to $8.
Right around $8. I think it's going to be a major, pretty high. So, which
it's a little tougher to do the straddle when it's a Monday earnings announcement as opposed to the Friday,
because you don't get that easy measurement of the one-day move.
Since you did get the move upwards with JP Morgan, do you see that this maybe, if we're looking in terms of risk, if they were to come out negatively, the risk to the downside maybe outweighing the risk to the upside?
Sure, because, you always ask the question, especially in financials, is everyone doing well, or is one bank eating someone else's lunch and affecting their numbers?
Or even say Goldman is doing well, they already get the move in anticipation of them doing well. And
exactly
these are all
right.
questions you kind of have to ask, and of course we don't know the answer.
Stock's up $4 today. Here's one way to do it. So here's one way to do it. Take the $5 out. That's 202, right? Now, if you think about a $7 move from there, it's about 195. So that's one way you could do it. Use the expected move without today's move or some fraction of it, and give yourself not a big number there.
Yeah, and I think on a Friday, you almost need to do something like that because the theta or the option decay is coming out. It won't fully come out, most likely, given there's an earnings report coming out Monday, but it's important to do that.
Let's see if we can make this a little better here. 197, 195, that's 41 cents. That's about the same for $2.50. The percentages are better there for sure. If we go 197, 192, now we're up to 70 cents. That's still not a great
trade. From a risk-reward standpoint, it's getting to the point where maybe it's not as appealing when you're up at $5 wide, especially if you've got an outsized move. Goldman does have things they're dealing with and stuff too. If you did see that downwards move, I'm not sure you'd want to have that much risk.
And historically, and we have talked about this on yesterday's show and with you in the past, these financials don't have great one-day expected moves, right? You just don't get the implied vol, because normally today's kind of an aberration on some of these financials.
Well, let's take a look and kind of get it into perspective here. We have it in the 31st percentile here on the platform. We do have to, discount it a little bit because of December, and also Goldman did have some Goldman specific issues they were dealing with that were, pumping up volatility a little bit. It is fairly elevated at 31, even though 31 seems low. So when you're looking at this, you're still talking about an $8 move. Do you maybe looking on the call side and saying, maybe part of the upside move may be discounted? I'm really comfortable based on good news and beat up banks. I'm comfortable kind of lowering our expectations here, maybe selling 5 of these put verticals about 125% probably from below the expected move, and we kind of just hit our home run on these financials. I certainly don't want to do anything too risky. So maybe do you reduce size a little bit then? Maybe do it 3 times in that case, or does that impact? Oh, this is a pretty low risk trade that we're putting on here. Probability of out of the money is probably pretty high. How about if we just do 5 of these? We'll put it in a little above the market at 70 cents. We'll confirm and send that, and that's as far as I'm willing to go with Goldman.
Yeah, and I think what I would do,
80% out of the money. Right.
Yeah, I mean, if I sold that put spread 5 times at 70 cents, I think I might even buy one put, like a 202.5 put, or just one, just to give me something. I know it reduces your credit, but it gives you some long on the downside, just a little bit against the short put spread. All right, Larry and Alex, thank you guys so much for hanging out with me in the A block here. Coming up next, Mr. Ben Watson is coming into this studio, and he's going to talk about Citigroup ahead of their earnings coming out on Monday. Stay right here on the TD Ameritrade Network. Fast Market. We'll be back in one moment.
Fast Market, everybody. I'm Kevin Hinks. Let's do a quick market update. E-minis 12.5. NASDAQ up 6. NASDAQ kind of unchanged. I would call NASDAQ unchanged. Dow futures up 198. The Dow is having the really big day, and the Russell up 0.25%. All right, let's get right to it. We have a lot to do today, and for that, I want to welcome in live from Salt Lake City right to Chicago, Illinois, in your doorstep. I want to welcome in Mr. Ben Watson to the studio. Good to see you, buddy.
It's good to be here,
Always
Kevin.
good to have you in Chicago.
Yeah, great stuff.
We have started. You know, I refer to it as 6 down, 494 to go in terms of the S&P 500. But we're going to get a good one here on Monday with Citigroup.
Right, and this is really part of the financials which kick off traditionally the earnings season. And we just had JP Morgan with that big move to the upside. Looking at Citigroup, a little bit of an interesting pattern though, and I love technical analysis patterns that look like this, because they add context. We get this expansion pattern where, you know, normally we look at squeezes, right?
I was going to say, this is the opposite of everything we've always looked at.
Exactly. This is exactly the opposite of a squeeze. This is where buyers and sellers are letting prices move apart from one another, and eventually the expectation is that they exhaust themselves, and generally it's the bullish momentum that exhausts itself. So an expansion pattern like this, which is sometimes referred to as a trumpet or a bugle type pattern.
I see why.
Yep, it oftentimes has some bearish implication to it, at least in the short term, in that you might see another move from the top line all the way back down to the bottom line. Now, Citigroup, that's a big move ahead of the earnings announcement. That earnings announcement could be the catalyst, but from a technical analysis perspective, there are a couple of levels of support here. We see that 65 level perhaps being a possible support if this bounces down and pulls back a little bit, but it very easily could make a move all the way back down to that 60 mark, which is the base of that kind of expansion triangle, if you will. Of course, no guarantees that it's going to go there or that it's going to go beyond, but you've got a couple of factors working in favor of maybe some bearish implication. Momentum falling off a little bit in this case, and you have a change in CEO, or in the president, in the management team, as well as declining cash flow over the last couple of quarters. So unless they tell a good story, there may be that expectation that this little short-term run that's been to the upside is what they get ahead of the earnings.
Ben, if you look, I have a couple things. Number one, if you look 3 months ago, they were one of the strongest financials coming out of earnings a quarter ago, because they had really good trading revenues and good numbers. Now, the fact that a couple of financials have already come out with earnings, and this is up 2% today, and it looks like it's through the top of one of your cones there. What does that do for any guidance going forward, or how do you look at that? It's already making a move.
Well, then I'm going to go back to the short-term candlestick here, right? The one-day candle, and that's going to give me some insight into what's going on in that daily battle. The fact that the candlestick went higher and is now pulling back maybe gives me an indication that there is, you know, some pop based on the news of the group as a whole, JP Morgan as well, pushing this price higher. But now as investors start to say, wow, there's the earnings announcement over the horizon on this stock, let's take that profit, get out of it, and then see that little bit of a pullback. So a little bit of a short-term pullback here on the day, that could take it right back down to that line. Now, some technical analysts, as we've talked about, like to see that breakout and a pullback back down to the support and a retest. Because remember, old resistance can sometimes become new support. And so some technical analysts are going to look for this as a level of support to bounce off of.
All right, you may have already answered this, but what is the reverse of a descending triangle? This is the other way. Right? What's the basic 101 definition of this versus, I remember, because you've gone over it 20 times on our show, I'd get it eventually, that you're looking for something big to break out when it goes to the point. What about in this case, it's the opposite.
Yeah, so great question to ask, because this is exactly that. This is resistance that's moving up and support that's moving down. Those two are moving further apart from one another. So if you think about it, buyers are buying at lower and lower prices, but sellers are also able to push prices from higher and higher levels. They're able to sell higher and higher and push prices all the way to the base of that triangle. So from a perspective of momentum, we look for those buyers perhaps to run out of that momentum. So this could take it to the bottom of the triangle and then break out. But more often than not, what happens in an expansion pattern like this is maybe it churns sideways for a little while out of this triangle, or it comes down and it now starts to make a short-term descending triangle or falling wedge against that lower support level.
All right, we have about a minute. I just want to know your final thoughts on what do you do? How do you adjust your expectations? I know what I do from a fundamental standpoint. How do you do it from technicals when it makes a move ahead of earnings like this, when one name comes out and the whole sector moves? What do you do there?
You have to go back to the basics and look at support and resistance levels and start to draw those lines in, connect the dots, and find those places where by no means is it going to guarantee that it's going to stop and change direction at that point, but where it has done that before and it becomes more likely that it's going to change direction at that point. And that's why we've drawn that diagonal line in there.
This is the opposite of everything we've ever talked about, but guess what? This is when you learn, right? This is a complete change in the normal pattern that we see. But I understand what you're saying. I hope our viewers do too. All right, Mr. Ben Watson hanging out with us in the studio. I so appreciate him coming. All right, coming up next, we've got another treat. The flow keeps coming in the studio. Landon Swan from Likefolio is live in the studio, and he's going to take you through exactly what Likefolio does. Oh, by the way, Jenny Horn is coming in too. So it's going to get interesting. Stay right with us on the TD Ameritrade Network. Fast Market. We'll be right back. Welcome back to Fast Market, everybody. I'm Kevin Hinks. Let's do a quick market update here. E-minis about $1 higher. Everything's just a little bit higher than where we were 10 minutes ago, so no real big change in the market. Still a nice, strong day. And as you know, VIX now 12.5. All right, we have something pretty special here to talk about for the next few minutes. And I am welcoming in not only Jenny Horn, live from the TD Ameritrade Network, but co-founder of Likefolio, Landon Swan, is live in studio to talk to us about Likefolio. Now, Landon, good to see you, buddy.
Good to see you.
Yeah.
Nice to be here in person.
Welcome to Chicago. First and foremost, he's taller in person, isn't he?
He is. He's definitely taller in person.
First thing I think when I see something like this, he could dunk on me. He can make me look really bad. I'd be that guy in his video like this. You know? I don't want to be that guy. All right. Okay. You are here to tell our viewers, give them a basic intro to what you guys do at Likefolio, and it's substantial. When we have you guys on, and we do it daily, talking about earnings, you can't argue with some of the data you guys put out. You guys have had a great run in terms of your data and their accuracy. So I think it's time for you to explain to our viewers how you get it done, what you do, and exactly what Likefolio does for TD Ameritrade clients and everyone who subscribes.
Absolutely, yeah. That's a good point because we're on here every day, and we have to get to the point very quickly. So today's a good time to expand a little bit. So what we do at Likefolio is we look at social media for shifts in consumer spending behaviors on Main Street before it becomes news on Wall Street. And so the way that we do that is we're looking for mentions of brands and products of publicly traded companies, and we roll those up to those companies, and then we look at how has that changed over time. And so one of the main things that we do is not only do we look at that tweet, but we're looking at, are people talking about spending money on that product? And that's really the key. We call that purchase intent. Purchase intent. That's a word we use a lot on this show. Exactly. So what that means is someone is on social media and they're talking about a brand or product, and they're talking about spending money on that brand or product. The reason that we track purchase intent is because that is what we tie to top line revenue. We've had a couple of universities do studies on it, proved through peer-reviewed published journals that it is predictive of top line revenue. And so,
first and foremost, I have my first question. Do you get your data 100% from Twitter, or do you use all social media?
It's 100% for Twitter. And
there you go. Okay.
We love that because people are forced to get to the point, right? You know, you've only got so much space to talk about what you're talking about. And for whatever reason, people love to share their entire lives on Twitter, and especially when they're spending money. They're going to a restaurant, they're buying a new iPhone, they're signing up for Netflix, whatever it may be. We're tracking that, and we're looking for that over time.
I believe you just described Jenny Horn in a nutshell.
Not quite, but we do talk about that a lot with the tourism stocks. People love to share, whether it's oversharing positive, negative news, they're definitely sharing.
Absolutely, absolutely. So One of the things that we do a lot of longer term trends, of course, but a huge advantage that Likefolio has is people are talking about spending money right now, and that's the current quarter. And we know that information during the fiscal quarter, and then the company will report that 4 or 5 weeks later. So that's our window of opportunity, and that's why when we come on this show, we're often talking about who's reporting this week and how we think they're going to do.
Yeah, you're giving the data out before the data is collected and published and put out by the company. You're giving the data as almost in real time, frankly.
That's right. Yeah, we're collecting it in real time, and then we aggregate it for the entire fiscal quarter, and we say what we think, how that quarter went exactly. And so one of the things that we do, we're on this show once a day, and we're able to do 5 a week, right? But we cover 300 companies, and so every quarter we're putting that data out on 300 companies. So we're not able to cover all of it on this show. So we've actually got a product called our Sunday earnings sheet where we put out a list of all the companies who are reporting in the upcoming week and how we think their fiscal quarter went and what we expect out of the
So
stock.
on Sunday, right? This comes out Sunday evening sometime, and it lists the earnings for the next week and and your data on each earnings name, right?
That's right. Yeah.
So you get a Sunday night pre-look, like a first look at the earnings for the next week.
Exactly. And I print these out. These are I carry these around with me.
The Bible?
It is wonderful. So for 10 weeks we've got these, and it's been 2 or 3 weeks of kind of no trading, and I'm so excited to get going again. This is our week 1, and we've got 10 more of them coming up. So the first one, our week 1, is coming out this Sunday. And so we've got the sheet up here, and I kind of want to walk through what it is because
a lot of columns,
a lot of data.
A little hard to put on camera, but try to give them the best view of it that
Absolutely.
you can.
Yeah, so on the far left, you've got which companies are reporting, and you'll notice that they're organized by day. And so the M is Monday, T is Tuesday. So you can see Bank of America and Progressive are, they're not reporting on Monday, but that's the last day that you can trade because they report Tuesday before.
Yeah, but if it's Tuesday morning, you got to trade it by the end of the day Monday. We deal with that a lot on this show.
Exactly. And so what we do for each company, that third column, or the historical confidence, is extremely important. So we are very transparent with the fact that some of our data is very good for some companies and it's so-so for others. And so we've got that back-tested data, and we're showing you exactly how well it's done. So every company's got a score from 0 to 10. So for example, Netflix is one of our better ones. It's got a win rate of 78% and plus 8% per trade. And so Netflix does extremely well, but we want to be very transparent about which ones are better and which ones are not.
Yeah, so break down Netflix for us, because that's a stock we talk a lot about with Likefolio data.
Sure. So I'll go through the columns with Netflix. That's a good plan. So the purple there, the QOQ, that's quarter over quarter change. And so for each one of those, it's how has the first one, how has purchase intent changed over the last quarter. So for Netflix, it's up 16%, while the stock, the next column, is up 39%. And we like to look at how those two relate to each other. And so 16 minus 39 is negative 23. In other words, the data does not support the stock going up this much, right? So that difference is what that is. And the next 3 columns are year over year. So we do quarter over quarter and year over year. A lot of companies are very seasonal, and so that's why we like to do year over year as well. So for Netflix, again, up 10% year over year, positive numbers, but the stock's up 21%. So our data doesn't necessarily support that run. So that difference is negative 11. So that results in a bearish call on Netflix because the data is strong, but the stock's run maybe a little bit too much.
Well, guess what? You just got your move. Go ahead, Jen.
So you mentioned,
you
mentioned in your trader thoughts this is not a long-term position. So what's a play you could make that would be short-term, obviously bearish, as you just mentioned?
Right. So, with Netflix, one of the things we're talking about the company being a little bit overbought here, not weak, right? There's a big difference there.
Big difference.
So a lot of times we see a situation where purchase intent is way down, and that's, we're ready to fire on those bearish. This is a little bit weaker.
You had one this week with Bed Bath & Beyond,
yeah.
right? A big bearish call on Bed Bath & Beyond, and the stock went down, what, 9.5%, almost 10%.
Yeah, we're happy with that one, obviously. But yeah, so with Netflix, it's before the Disney news comes out, then it's maybe not a long-term bearish play. With Disney, maybe it is. But just looking at the data, it's bearish in the short term. So a lot of times people want to trade these in a way that is risk defined, obviously.
Of course.
That's fantastic. So if you want to look at maybe a May put spread, something like that, that'd be a good way to play Netflix. And so, we do this for every single company. This is page 1 of week 1.
Yeah.
We got 300 companies every week or every quarter. And so this is, I'm so excited to finally get going. This is not the most exciting week, I would say. With Netflix is awesome, but we've got Apple and Amazon and Tesla coming up over the next couple of weeks.
And think
so
about
we're ready
this.
to go.
When, the social media data gets stronger as you get into earnings on some of these names. Think about Apple and the social media on Apple.
Yeah.
Think about Tesla, how big Tesla is on social media, all these companies. And so what I'm getting at here is the sample size, right?
Oh, yeah.
I mean, some don't have a lot of tweets. Some have a massive amount of tweets. Jenny is in charge of collecting those for us.
loves going through
Some are easier than others.
Exactly,
Definitely.
right? So how does that affect what you guys do?
So sample size is really important. So actually we've got a couple in this upcoming week that are kind of low sample size, and we call those out in the trader notes. So the trader notes are essentially our interpretation. We've been doing this for a couple of years now.
Yeah.
We've read the studies, we know how this is predictive, and we know what to look for. And so inside those trader notes, we talk about how to play it, why we're going this way, and maybe why you should avoid this trade. And low sample size is one of those reasons. But for a company like Netflix, the sample size
is there bullish, bearish, neutral readings?
Absolutely.
Some is like, we're kind of in the middle.
So and this week we've got like 10 companies reporting.
Yeah.
Not that many first week, and we've only got 4 calls.
Right.
3 bearish and 1 bullish this week.
Sometimes it's right in the middle, right?
Exactly.
You don't have anything.
If we agree with the market, like purchase intent's up 20% and the stock's up 20%, we have no edge, right? The market's already priced in what we think should be happening. But if purchase intent's up 20% and the stock is flat or down, that's when we're firing bullish.
Yeah.
Now,
Go
are
ahead.
there any limitations with this? Because occasionally we do talk about companies where we don't mention any non-English speaking tweets.
Right. So the limitations are this is consumer facing only. We're not covering Alco, and nobody tweets about buying that stuff.
Right.
And it's English speaking only. So primarily the companies that we cover are English, or U.S. companies. We've got a few Canadians and a few in Great Britain, but generally speaking, the customers have to be English speaking.
Okay, now you have a relationship with TD Ameritrade. But how can people get more information on Likefolio, or people that maybe just watch this network get a relationship with Likefolio itself?
Sure. So obviously they should be watching this every day, right?
Clearly.
Of course.
Thank you.
Absolutely. But
That
then
just
also,
got you invited back, by the way.
but yeah, just likefolio.com. That's it. If you go there, you'll actually see a link for a demo to go over this. I know this is kind of a quick hit,
Right.
But we have a long demo that goes over exactly how this works and how you can get it at likefolio.com.
All right, this is stuff, and people have the right to be a little skeptical when they see it for the first time, but the more you spend time with this, the more a part of your trading it becomes. And we use it on Fast Market. We go through, we take the keys off of some of this data, and it's hard to argue. Right?
It is. Bed Bath & Beyond this week was the perfect example of
massive.
that.
Yeah, win.
Yeah, I'm still riding high from Weight Watchers as well.
Weight Watchers was another one. I mean, you've had some pretty strong calls, and some of them, frankly, against the grain of the trend in the market.
And that's what we look for. We look for when we disagree with the market. We call that
divergence. I've heard you guys
divergence.
say that on the air, where the stock is not acting like your data.
Right. So there's an underlying assumption that we know exactly how much people are buying these products, and if we go with that assumption and we see what the stock price is doing, we think it should be going up and it's going down. That's where we love. That's what we want. When we agree with the market, it's nice to be. It's nice to be right, but you can't make money, right?
Exactly.
So we want
divergence.
Divergence. We want the market to be wrong. Exactly.
All right, Landon Swan, thank you so much for coming.
Absolutely.
You'll be at the Market Drive with us all tomorrow for TD Ameritrade clients.
Can't wait.
Make sure you know that at the Hyatt Regency downtown. Jenny Horn will be there as well.
I will be there as well.
So we'll all be downtown at the Hyatt Regency. All right, guys. Thank you, Jenny. Thank you, Landon, for coming on. Coming up next, we're back to trading. We're going to trade Citigroup off Ben Watson's look here when Fast Market continues. Stay right with us. Welcome back to Fast Market, everybody. I'm Kevin Hinks, joined again by Alex Coffey and Mr. Larry Shover. Let's get right into it, guys, because we've already talked about Goldman. We also have Citigroup. Now, Citigroup, I think, is important. Ben Watson just gave us a nice breakdown of Citigroup, and he gave me something really that's different than a lot of things that we talk about on this show. You can see his kind of reverse triangle there, right? Okay. Normally he gives us, and it's going the other direction. So Ben really covered this pretty extensively. But what I want to talk to you guys about is this. Look at a quarter ago. A quarter ago, Citigroup was the strongest of the financials coming off their earnings and had a big two-day move. Mm-hmm. Now, that being said, it's up about 1.7%. That's down off it. It was up 2% just a little while ago. How is this, much like Goldman, up almost $5 today? How do you trade these when they've already made a move ahead of the event?
Yeah, and for me, it's really more about, I need to know what the implied volatility is to start the whole conversation. It's easy to say, oh, it's near its 52-week high, which, $3 or $4 away from that. So it's easy to say, hey, I want to get short the stock somehow. That might not be the case. I think I'd rather know what the implied volatility is and the implied move for Monday. IV
percentile, 29%. Now, remember, this is these Monday earnings releases. Really, you don't get the benefit of the market maker move.
Yes.
You have to do it kind of the napkin calculation for market maker move. So what you do is you open up that 6 days out till expiration and you look at the at-the-money straddle, right? If it's 67, it looks like it's about, what is that, one?
Well, if you look right here, it's showing about a $2.50 move for the entire week. And if you go out 1 week past that, about $3.11. So just quick math, about 60 cents in the next week. If you took that 60 cents out, you're looking around $1.90 or $2.
Yeah.
That's kind of how I do it, just as a quick little way to do it, just since it's Monday. If this was Wednesday, you might do it a little bit differently.
Yeah, you do. Well, I mean, that's a good point, Alex. With a Monday earnings, you got to be cognizant because that earnings play that you're focusing, right, has 4 more days till expiration. So not only do you have to look at the one-day move, and it's $2.45, so it's probably somewhere $2, something, right around there. But you've got a 1 week move of $2.54. Yeah. You got to be cognizant of both here, I think, on this one.
Yeah.
Especially knowing what you knew last quarter on Citigroup.
Yeah, exactly. Strong consumer loan growth relative to the others, less impact to the yield curve, cheap valuation relative. But it seems like so much of the news is out on Friday, so I think Citigroup's going to have a big splash on Monday to go past.
To just hold this level.
Yeah, and if we look at current IV percentile, you're looking at a 29%. But because we did have that down move in December, I kind of want to put the actual chart study on here just so we can see, is this high or low volatility? And as you see, even though it's 31%,
I wouldn't call it low.
It's not low because so much of it was tied to this move downwards with the rest of the market. That being said, it's not overly high either.
I think a 1 year look at this I do it all the time. I would never look at the IV percentile without making sure that there's no data like this peak right here that you see that skews the data. And that does. That mountain right there, that peak in implied vol on this big sell-off, which is December 24th. Unfortunately, you have a lot of those, right, where the vols kind of had kind of an outlying move.
Yeah.
So it's not at its peak level right now, but it's been lower.
It absolutely has been lower, and it probably would be if you took that move downwards out, maybe closer to 60 or 70th percentile. But also, you have to keep in mind where we are in the market as well. I mean, we're talking about the VIX in the 12 handle.
Yes.
The whole market volatility is pretty depressed right now. So seeing this even, as high as it is, relatively, it is fairly elevated due to this event risk.
See, I believe, and this is a good thing and it's a bad thing at the same time because the play was the first earnings play in financials.
That's right.
Now all of them are going to be a little bit skewed by the ones that came out already.
Exactly.
So, the blatant up move might be already in this market. This stock could have good earnings on Monday and do nothing.
I tend to agree with you on that. So if that's the way that you were leaning to play it, it may even be a pass for that reason.
Or just simply a play no movement. right?
Or exactly, or play something a little bit more neutral. But if you think, maybe Citigroup in particular, maybe their story isn't going to be built up the same as JP Morgan, they may actually miss. You may have an opportunity in that sense because you got that little bit of a run up today.
Yeah, I think we just gave every opinion. I think all three opinions.
And mine is, if the vol is actually cheap enough, I would play variance, meaning I would play the move one way or the other through maybe like an iron butterfly, being long an iron butterfly or something like that, buying the straddle, selling the
Believe me, a move that is not very popular, we don't do it all the time in here, in JP Morgan worked. And it worked well. I mean, they were looking for about, at the end of the day, right around $2, right at $1.98, and it came out a $4 move.
Yeah.
It's going to be very difficult. I don't going to say never. It's very difficult to make money when that move doubles the expected move from the short side, right? You're hanging on for dear life. But however, just a one last straddle had a nice little day here.
Absolutely. And there's times to be long vol, there's times to be short vol. And as a retail trader, it's hard to be long vol because you're just going to lose more than you win.
And you look on the calendar and you know that this time of the year is not conducive to higher VIX unless you get some event.
Exactly. So,
and looking at the chart too, based off what Ben has drawn on here, we're kind of bumped up against a resistance point. It absolutely doesn't mean that we can't go through that on this earnings announcement, but it is important to note that we have tried to go through it today and we haven't been able to. To me, this is if I don't have an opinion because you saw the move upwards, I would tend to be a little bit more neutral, as you said, but maybe even play back, maybe just a reversion a little bit in case they do miss.
So, go ahead, Larry.
No, so would you play like the short iron butterfly then,
or maybe
iron condor?
Look at it as maybe if you could get a call spread above the market that you could sell, because if you're playing that, even if they beat, maybe it's a little bit priced in now. That you kind of anticipate that risk maybe isn't as much as it would have been if it was JP Morgan.
Yeah, I like that because the bottom line is the bar has been raised all of a sudden.
Yes.
And so it's going to be something fantastically better on Monday for them to really, see some variance in the stock.
Right, because think about it, a 2% move in this stock, which is just about, remember, you talked about $1.90 is the expected move. It just made it. On the day before earnings came out. That's significant. It has to be put into your general thinking here on Citigroup.
The difficult thing is if you're looking at it here, building it out, $1 wide at $2 above the market is only about 23 cents.
That's very low.
But with it being only $1 wide as a percentage of the risk, it's not that much lower than a typical trade that maybe we look at like we did even with Goldman. It's about the same risk reward. You're about 75% probability of success at that level. But the problem is it just, you got to make
it's the absolute money.
The amount of contracts that you have to do to really make that an appealing trade, it kind of can get a little bit of, commission intensive potentially.
Absolutely.
I'm here working because I want to do, if we turn that into an iron condor now, a $1 iron condor, like I said, $2 below, $2.20 below, and what's that about, $1.70 above. That's a 41-cent credit. That's not bad for iron condor.
And if you wanted to, say you were saying, I think the risk is further to the downside, you could even skew this out, make that a little bit wider on the upside, and collect a little bit more. You can do things playing with the strikes to kind of meet whatever that bias that you have.
What if we did that? Now that makes perfect sense to me because just a little bit outside the expected move on both sides, and it gets right to that 30-cent level, which is it's kind of the one the benchmark that we look for on a $1, 30 cents per dollar is about normal.
About 1/3.
Right. So here's what we can do. Knowing what we know, right? If I was going to skew this, I would skew the put spread because I think that's where you may have some safety on the downside. Because even if it goes down $2, right? You're still above where it was.
Okay. And that's 48-cent credit.
Right. Okay. Exactly. And so now. Think about this, with a $1 move on the upside, if it goes on the upside, you only have a 52-cent risk on the upside because, see, you've skewed that. I think the relief rally in financials is real. Sure. I think you're seeing it today. Now, does that mean this is going to power $2.50 higher? I don't know about that, right?
Right.
But this is a way to get a little bit of a long delta and still play a range just in case nothing happens.
Yeah, I mean, this comes down to whatever your fundamental opinion on the direction of Citigroup as a company is going to do, and you've shown how you can kind of play with those strikes within one strategy and get different opinions.
Larry, are you a fan of taking your opinion and taking the fundamentals of trading and embedding them in the fundamentals? Like, this is clearly a one that gives us about 8.5 deltas per spread.
Yeah, and I think that's the best way to look at things. When you have a conviction, knowing full well that the best thing you can do is take advantage of the options market to help, not really put the odds in your favor, but get the odds, just a little bit better.
Right, because the genesis of any trade should be your opinion.
That's right.
All right, we're going to throw this one in, guys. I kind of like the way we've created this here. Kind of a collaboration here. Trading 47. We're going to put it in 48. We'll lock it in at 48 cents. All right? And that is in. Now, guys, let's close this show up with a little discussion, because after this, we've got, we'll have Bank of America coming out Tuesday. We'll have Morgan Stanley coming out Wednesday, and the financials keep coming. Now, do we hit diminishing returns on these names? We only got about 1 minute left. How do we trade the rest of the financials, Larry, quickly?
I really think you have to trade it from the long volatility side, long variance side. It's hard to do as a retail trader, but given the implied vols relatively are cheap and getting cheaper, it's going to be hard to find a value proposition on the short side.
All right, guys, I'm sorry, we got to go. Thank you so much, Larry and Alex, for being here. That does it for our Fast Market show today. Please tune in Monday at 10 a.m. Central for another edition of Fast Market. Have a great weekend, everybody. See you at the Chicago Market Drive. Don't forget to come. We'll all be there. Have a great day.